School of Management Studies IGNOU presents an audiobook on the course MMPC 010 titled Managerial Economics for MBA Program. Presenting Block 1 titled Introduction to Managerial Economics. Unit 2 The Firm, Stakeholders, Objectives and Decisions Issues.
Objectives. After studying this unit, you should be able to understand the rationale for existence of firms, understand the concept of economic profit and accounting profit, appreciate the use of opportunity cost, differentiate between various objectives of the firm. Introduction. The firm is an organization that produces a good or service for sale, and it plays a central role in theory and practice of managerial economics. In contrast to non-profit institutions like the Ford Foundation, most firms attempt to make a profit. There are thousands of firms in India producing large amount of goods and services. The rest are produced by the government and non-profit institutions. It is obvious that a lot of activities of the Indian economy revolve around firms. One of the crucial determinants of a firm's behavior is the state of technology. Technology imposes a limit on how much a firm can produce. It is the sum total of society's pool of knowledge concerning the industrial and agricultural arts. Production is any activity that transforms inputs into output and is applicable not only to the production of goods like steel and automobiles, but also to production of services like banking and insurance. The firm changes hired inputs into saleable output. An input is defined as anything that the firm uses in its production process. Most firms require a wide array of inputs. For example, some of the inputs used by major steel firms like XYZ or ABC are iron ore, coal, oxygen, skilled labor of various types, the services of blast furnaces, electric furnaces and rolling mills, as well as the services of the people managing the companies. To give another example, the inputs in production and sale of chaat by a street vendor are all the ingredients that go into making of the chaat, that is, the stove, the carrier, and the services of the vendor. The inputs or the factors of production are divisible into two broad categories: human resources and capital resources. Labor resource and entrepreneurial resource are the two human resource inputs, while land, man-made capital forests, rivers, etc. are the two capital resources. Thus, the four major factors of production, FOP, are land, man-made capital, labor, and entrepreneur or organization, while the remuneration they get is rent, interest, wage, and profit respectively. The function of the firm, thus, is to purchase resources or inputs of labor, services, capital, and raw materials in order to convert them into goods and services for sale. There is a circular flow of economic activity between individuals and firms as they are highly interdependent. Labor has no value in the market unless there is a firm willing to pay for it. In the same way, firms cannot rationalize production unless some consumer is willing to buy their products. However, there is some incentive for each. Firms earn profits, in turn satisfying the consumption demand of individuals, and resource owners get wage, rent, and interest payment. In the process of supplying the goods and services that consumers demand, firms provide employment to workers and also pay taxes that government uses to provide service that firms could not provide at all or as efficiently. Essentially, a firm exists because the total cost of production of output is lower than if the firm did not exist. There are several reasons for lower costs. Firstly, long-term contract with labor saves the transaction costs because no new contract has to be negotiated every time a labor is to be hired or given new assignment. Secondly, there are government regulations like price control and sales taxes also saved by having the transaction within the firm. Recall that sales tax is levied for transaction between firms and not within firms. When transactions take place within a firm, they may be cheaper, and hence such savings decrease the total cost of production of an output. In other words, the existence of firms could be explained by the fact that it saves transaction costs. However, the size of the firm has to be limited because as the firm grows larger, a point is reached where the cost of internal transaction becomes equal to or greater than the cost of transaction between firms. When such a stage is reached, it puts a limit to the size of the firm. Further, the cost of supplying additional services like legal, medical, etc. within the firm exceeds the cost of purchasing these services from other firms, as such services may be required occasionally. Let us consider the size of different kinds of firms around us and try to understand the reasons for such differences. Why are service firms generally smaller than capital-intensive firms like steel and automobile producing companies? What is the reason that a number of firms are choosing the BPO route? A part of the explanation must lie in the fact that it is cheaper to outsource than to absorb that activity within the firm. Consider a firm that needs to occasionally use legal service. Under what conditions will it choose to hire a full-time lawyer and take her or him on its roles? And under what conditions will the firm outsource the legal activity or hire legal services on a case-by-case basis? Naturally, the answer depends upon the frequency of use for legal services. The transaction cost framework demonstrates that the firm will contract out if the cost of such an arrangement is lower and will prefer in-house legal staff when the opposite is true. Firms are classified into different categories as A. Private sector firms, B. Public sector firms, C. Joint sector firms, D. Non-profit firms. Firms can also be classified on the basis of number of owners as A. One-person company, B. Partnership, C. Corporations. Some firms mentioned below are different from the above. They may provide service to a group of clients, for example, patients, or to a group of its members only. A. Universities, B. Public libraries, C. Hospitals, D. Museums, E. Churches, F. Voluntary organizations, G. Cooperatives, H. Unions, I. Professional societies, etc. The concept of a firm plays a central role in the theory and practice of managerial economics. It is, therefore, valuable to discuss the objectives of a firm. Objective of the firm. The traditional objective of the firm has been profit maximization. It is still regarded as the most common and theoretically the most plausible objective of business firms. We define profits as revenues less cost, but the definition of cost is quite different for the economist than for an accountant. Consider an independent business person who has an MBA degree and is considering investing 1 lakh rupees in a retail store that she would manage. There are no other employees. This accounting or business profit is what is reported in publications and in the quarterly and annual financial reports of business. The economist recognizes other costs defined as implicit costs. These costs are not reflected in cash outlays by the firm, but are the costs associated with foregone opportunities. Such implicit costs are not included in the accounting statements but must be included in any rational decision-making framework. There are 2 major implicit costs in this example. First, the owner has 1 lakh rupees invested in the business. Suppose the best alternative use for the money is a bank account paying a 10% interest rate. This riskless investment would return 10,000 rupees annually. Thus, 10,000 rupees should be considered as the implicit or opportunity cost of having 1 lakh rupees invested in the retail store. Let us consider the second implicit cost, which includes the manager's time and talent. The annual wage return on an MBA degree may be taken as 35,000 rupees per year. This is the implicit cost of managing this business rather than working for someone else. Looking at this broader perspective, the business is projected to lose 25,000 rupees in the first year. 20,000 rupees accounting profit disappears when all relevant costs are included. Another way of looking at the problem is to assume that 1 lakh rupees had to be borrowed at say 10% interest and an MBA graduate hired at 35,000 rupees per year to run the store. In this case, the implicit costs become explicit and the accounting made explicit. Obviously, with the financial information reported in this way, an entirely different decision might be made on whether to start this business or not. Thus, we can say that economic profit equals the revenue of the firm minus its explicit costs and implicit costs. To arrive at the cost incurred by a firm, a value must be put to all the inputs used by the firm. Money outlays are only a part of the costs. Economists also define the opportunity cost. Since the resources are limited and have alternative uses, you must sacrifice the production of a good or service in order to commit the resource to its present use. For example, if by being the owner manager of your firm, you sacrifice a job that offers you 2 lakh rupees per annum, then 2 lakhs is your opportunity cost of managing the firm. Similarly, if Suresh Kumar was not playing cricket, he could have earned a living by being a cricket commentator. Suresh's opportunity cost of playing cricket is the amount he could have earned being a cricket commentator. The assignment of monetary values to physical inputs is easy in some cases and difficult in others. All economic costing is governed by the principle of opportunity cost. If the firm maximizes profits, it must evaluate its costs according to the opportunity cost principle. Assigning costs is straightforward when the firm buys an input on a competitive market. Suppose the firm spends 20,000 rupees on buying electricity. For its factory, it has sacrificed claims to whatever else 20,000 rupees can buy, and thus the purchase price is a reasonable measure of the opportunity cost of using that electricity. The situation is the same for hired factors of production. However, a cost must be assigned to factors of production that the firm neither purchases nor hires because it already owns them. The cost of using these inputs is implicit costs and has to be imputed. Implicit costs arise because the alternative cost doctrine must be applied to the firm. The profit calculated after including implicit as well as explicit costs in total cost is called economic profit. Profit plays 2 primary roles in the free market system. First, it acts as a signal to producers to increase or decrease the rate of output or to enter or leave an industry. Second, profit is a reward for entrepreneurial activity, including risk-taking and innovation. In a competitive industry, economic profits tend to be transitory. The achievement of high profits by a firm usually results in other firms increasing their output of that product, thus reducing price and profit. Firms that have monopoly power may be able to earn above normal profits over a longer period. Such profit does not play a socially useful role in the economy. Although profit maximization is a dominant objective of the firm, other important objectives of the firm other than profit maximization that we will discuss in this unit are 1. Maximization of sales revenue, 2. Maximization of firm's growth rate, 3. Maximization of manager's own utility or satisfaction. 4. Making a satisfactory rate of profit. 5. Long-run survival of the firm. 6. Entry prevention and risk avoidance. Value maximization. Most firms have sidelined short-term profit as their objective. Firms are often found to sacrifice their short-term profit for increasing the future long-term profit. Thus, the theory states that the objective of a firm is to maximize wealth or value of the firm. For example, firms undertake research and development expenditure on new capital equipment, or major marketing programs which require expenditure initially but are meant to generate future profits. The objective of the firm is thus to maximize the present or discounted value of all future profits. Thus, maximizing the discounted value of all future profits is equivalent to maximizing the value of the firm. For example, in a company, the marketing managers and sales representatives work hard to increase its total revenues, while its production managers and manufacturing engineers strive to reduce its total costs. At the same time, its financial managers play a major role in obtaining capital and hence influence the equation, while its research and development personnel invent and reduce its total costs. All of these diverse groups affect the company's value, defined here as the present value of all expected future profits of the firm. Alternative objectives of the firms. Economists have also examined other objectives of firms. We shall discuss some of them here. According to Baumol, most managers will try to maximize sales revenue. There are many reasons for this. For example, the salary and other earnings of managers are more closely related to sales revenue than to profits. Banks and financiers look at sales revenue while financing the corporation. The sales revenue trend is a readily available indicator of performance of the firm. Growth in sales increases the competitive strength of the firm. However, in the long run, sales maximization and profit maximization may converge into one objective. Another economist, Robin Maris, assumes that owners and managers have different utility functions to maximize. The manager's utility function, UM, and owner's utility function, UO, are UM is equals to F, bracket, salary, job, power, prestige, status, bracket close. UO is equals to F, bracket, output, capital, profit, share, bracket close. By maximizing the variables, managers maximize both their own utility function and that of the owners. Most of the variables of both managers and owners are correlated with a single variable, namely the size of the firm. Maximization of these variables depends on the growth of rate of the firm. Thus, Maris argues that managers will attempt to maximize growth rate of firms. However, this objective does not completely discard the profit maximization objective. According to Oliver Williamson, managers seek to maximize their own utility function subject to a minimum level of profit. The utility function which managers seek to maximize include both quantifiable variables like salary and slack earnings and non-quantifiable variables like power, status, security of job, etc. The model developed by Syed March focuses on satisficing behavior of managers. The firm has to deal with an uncertain business world and managers have to satisfy a variety of group of staff, shareholders, customers, suppliers, authorities, etc. All these groups have often conflicting interests in the firm. In order to reconcile between the conflicting interests and goals, managers form an aspiration level of the firm combining the following objectives: production, sales, and market share, inventory, and profit. The aspiration levels are modified and revised on the basis of achievements and changing business environment. As is true with most economic models, the application will depend upon the situation and one cannot say that a particular model is better than the other. In general, one can assert that the profit maximizing assumption seems to be a reasonable approximation of the real world, although in certain cases there might be a deviation from this objective. Goals of real-world firms. By now, we know that firms that maximize profits are not just concerned about short-run profits, but are more concerned with long-term profits. They may not take full advantage of a potential monopolistic situation. For example, many stores have liberal return policies. Many firms spend billions on improving their reputation and want to be known as good citizens. The decision maker's income is often a cost of the firm. Most real-world production takes place in large corporations with 8 to 9 levels of management, thousands of stakeholders, and boards of directors. Self-interested decision makers have little incentive to hold down their pay. If their pay is not held down, firms' profit will be lower. Most firms manage to put some pressure on managers to make at least a pre-designated level of profit. In the modern corporation, the owners or stakeholders hire managers to conduct the day-to-day operations of the firm. These managers are paid a salary to represent the interests of the owners, ostensibly to maximize the value of the firm. A board of directors is elected by the owners to meet regularly with the managers to oversee their activity and to try to ensure that the managers are, in fact, acting in the best interest of the owners. Because of the difficulty of monitoring the managers on a continual basis, it is possible that goals other than profit maximization may be pursued. In addition to those mentioned earlier, the managers may seek to enhance their positions by spending corporate funds on fancy offices, excessive and expensive travel, club memberships, and so forth. In recent years, many corporations have taken action to align the interests of owners with the interest of the managers by tying a large share of managerial compensation to the financial performance of the firm. For example, the manager may be given a basic salary plus potentially large bonuses for meeting such goals as attaining a specified return on capital, growth in earnings, and increase in the price of the firm's stock. With regard to the latter, the use of stock options awarded to top managers is a most effective way to ensure that managers act in the interest of the shareholders. Typically, the arrangement provides that the manager is to receive an option to buy a specified number of shares of common stock at the current market price for a specified number of years. The only way the executives can benefit from such an arrangement is if the price of stock rises during the specified term. The option is exercised by buying the shares at the specified price, and the gain equals the increase in share price multiplied by the number of shares purchased. Sometimes the agreement specifies that the stock must be held for several years following purchase. Essentially, this option arrangement makes the manager a de facto owner even if the option has not been exercised. In almost every case of a report of unusually high executive compensation, the largest part of the compensation is associated with gains from stock options. Emergence of oligopoly, a market structure characterized by the existence of a few large firms, mergers and amalgamations have made the structure of industries concentrated so that few large firms account for a major portion of an industry's output. This shifts the pressure on each firm to maximize profit independently and leads to joint profit maximizations through cartels and collusions. Profit maximization may not be the only inevitable objective. India's global companies and their objectives. One of the most significant business and economic trends of the late 20th century is the rise of global or stateless corporation. The trends toward global companies are unmistakably and are accelerating. The sharpest weapon that a corporation can develop to survive and thrive in the globalized marketplace is competitiveness. Its cornerstone, as articulated by strategy guru Michael Porter, is its ability to create more value on a sustainable basis for the customer than its rivals can. Many Indian corporations, such as an Indian multinational conglomerate pharmaceutical company, among others, are competing on the world stage. Whatever product or service a company offers, it must meet the customer's wants in the most satisfactory manner. This should be the aim of the company. The competitiveness of company in the global marketplace comes from both quality and scale. The challenge is to remain at the top. That challenge is linked with productivity. Pharmaceutical companies' greatest strength lies in the fact that it is strongly backward integrated. It helps them manage cost across the entire value chain, making them extremely cost competitive. Cost leadership is a function of scale and technology. By upgrading technology, pharmaceutical companies could continue to be a cost leader. A company has to continuously upgrade itself on several parameters: production efficiency, production development, quality management, and marketing skills. This competitiveness, defined by Michael Porter as the sustained ability to generate more value for customers than the cost of creating that value. Many new entrepreneurs and new industries are emerging who are able to operate successfully in this changed environment. Firms' constraints. Decision-making by firms takes place under several restrictions or constraints such as resource constraints. Many inputs may be available in a limited or fixed quantity, example, skilled workers, imported raw material, etc. Legal constraints. Both individuals and firms have to obey the laws of the state as well as local laws. Environmental laws, employment laws, disposal of wastes are some examples. Moral constraints. These apply to actions that are not illegal but are sufficiently consistent with generally accepted standards of behavior. Contractual constraints. these bind the firm because of some prior agreement, such as long-term lease on a building or a contract with a labor union that represents the firm's employees. Decision-making under these constraints with optimal results is a fundamental part of managerial economics. Basic factors of decision-making. The incremental concept. Incremental reasoning involves estimating the impact of decision alternatives. The two basic concepts in the incremental analysis are incremental cost IC, incremental revenue IR. Incremental cost is defined as the change in total cost as a result of change in the level of output, investment, etc. Incremental revenue is defined as the change in total revenue resulting from a change in the level of output, prices, etc. A manager always determines the worth of a decision on the basis of the criterion that is IR greater than IC. A decision is profitable if it increases revenue more than it increases cost, it reduces some costs more than it increases others, it increases some resources more than it decreases others, it decreases costs more than it decreases revenues. The acceptance or rejection of an order by a firm for its product depends on whether the resultant costs are greater or less than the resultant revenue. If these principles are not followed, the equilibrium position would be disturbed. But the problem with the concept of marginalism is that the independent variable may be subject to bulk changes instead of unit changes. For example, a builder may not change one laborer at a time, but many of them together. Similarly, the output may change because of a change in process, pattern, or a combination of factors which may not always be measured in unit terms. In such cases, the concept of marginalism is changed to incrementalism, or in other words, incrementalism is more general, whereas marginalism is more specific. All marginal concepts are incremental concepts, but all incremental concepts need not be marginal concepts. The equi-marginal principle. According to this principle, different courses of action should be pursued up to the point where all the courses provide equal marginal benefit per unit of cost. It states that a rational decision maker would allocate or hire his or her resources in such a way that the ratio of marginal returns and marginal costs of various users of a given resource or of various resources in a given use is the same. For example, a consumer seeking maximum utility from his consumption basket will allocate his consumption budget on goods and services such that MU1 by MC1 is equals to MU2 by MC2 is equals to MUN divided by MCN, where MU1 is equals to marginal utility from good 1, MC1 is equals to marginal cost of good 1, and so on. Similarly, a producer seeking maximum profit would use the technique of production input mix, which would ensure MRP1 by MC1 is equals to MRP2 by MC2 is equals to so on MRPN by MCN, where MRP1 is equals to marginal revenue product of input 1, MC1 is equals to marginal cost of input 1, and so on. It is easy to see that if the above equation was not satisfied, the decision makers could add to his or her utility profit by reshuffling his or her resources or input. Example, if MU1 by MC1 is greater than MU2 by MC2, the consumer would add to his or her utility by buying more of good 1 and less of good 2. In the real world, often the equi-marginalism concept has to be replaced by equi-incrementalism. This is because changes in the real world are discrete or lumpy, and therefore the concept of marginal change may not always apply. Instead, changes will be incremental in nature, but the decision rule or optimizing principle will remain the same. The discounting principle. Many transactions involve making or receiving cash payments at various future dates. A person who takes a house loan trades a promise to make monthly payments for, say, 15 or 20 years for a large amount of cash now to pay for a home. This case and other similar cases relate to the time value of money. The time value of money refers to the fact that a rupee to be received in the future is not worth a rupee today. Therefore, it is necessary to have techniques for measuring the value today, that is, the present value of rupees to be received or paid at different points in the future. This section outlines the approach to analyzing problems that involve payment or receipt of money at one or more points in time. The opportunity cost principle. The opportunity cost of anything is the return that can be had from the next best alternative use. A farmer who is producing wheat can also produce potatoes with the same factors. Therefore, the opportunity cost of a quintal of wheat is the amount of the output of potatoes given up. The opportunity costs are the costs of sacrificed alternatives. Whenever the manager takes a decision, he chooses one course of action, sacrificing the other alternative courses. We can therefore evaluate the one which is chosen in terms of the other, next best alternative that is sacrificed. A machine can produce either X or Y. The opportunity cost of producing a given quantity of X is the quantity of Y which it would have produced. The opportunity cost of holding 1000 rupees as cash in hand for 1 year is the 10% rate of interest which would have been earned had it been invested in the form of fixed deposits in the bank. All decisions which involve choice must involve opportunity cost calculation. The opportunity cost may be either real or monetary, either implicit or explicit, either non-quantifiable or quantifiable. Opportunity cost's relevance is not limited to individual decisions. Opportunity costs are also relevant to government's decisions which affect everyone in society. A common example is the guns versus butter debate. The resources that a society has are limited. Therefore, its decision to use those resources to have more guns means that it must have less butter. Thus, when society decides to spend 100 crore on developing a defense system, the opportunity cost of that decision is 100 crores not spent on fighting drugs, helping the homeless, or paying off some of the national debt. For many of the choice society make, opportunity costs tend to increase as we choose more and more of an item. Such a phenomenon about choice is so common, in fact, that it has acquired a name, the principle of increasing marginal opportunity cost. The principle states that in order to get more of something, one must give up ever-increasing quantities of something else. In other words, initially the opportunity costs of an activity are low, but they increase the more we concentrate on that activity. The invisible hand. Adam Smith, the father of modern economics, believed that there existed an invisible hand which ruled over the economic system. According to him, the economic system, left to itself, is self-regulating. The basic driving force in such a system is trying to enhance its own economic well-being. But the actions of each unit, acting according to its own self-interest, are also in the interests of the economy as a whole. Producers are led by the profit motive to produce those goods and services which the consumers want. They try to do this at the minimum possible cost in order to maximize their profits. Moreover, if there is a competition among a number of producers, they will each try to keep the price of their product low in order to attract the consumers. The goods produced are made available in the market by traders. They also act in their own self-interest. However, in a self-regulating economy, there is rarely any shortage of goods and services. Decisions to save and invest are also taken by the individual economic units. For example, households save some of their income and deposit part of it in the banks or invest it in shares and debentures and so on. The producers borrow from the banking system and also issue shares and debentures to finance their investments. In turn, they reinvest a part of their profits. All the economic functions have been carried out by individuals acting in isolation. There is no government or centralized authority to determine who should produce what and in what quantity. and where it should be made available. Yet, in a self-regulating economy, there is seldom a shortage of goods and services. Practically everything you want to buy is available in the market. Thus, according to Adam Smith, the economic system is guided by the invisible hand. In a more technical way, we can say that the basic economic problem in a society is solved by the operation of market forces. Summary. There is a circular flow of economic activity between individuals and firms as they are highly interdependent. The firm's existence is based on manifold reasons. Firms are classified into different categories. Different firms belonging to the same industry, facing the same market environment, behave differently. Thus, the necessity for theories of the firm. Profit is defined as revenue minus costs, but the definition of cost is quite different for economist than for the accountant. Short-term profit has been sidelined by most firms as their objective for increasing the future long-term profit. Real-world firms often have a set of complicated goals. The basic factors of decision-making can be outlined by various principles.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 010, titled Managerial Economics. Course coordinator Dr. Leena Singh. Voiceover by Renuka. Edited by Savita. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.